You and today our topic is behavioral finance and how this behavioral finance is applicable to trading and financial markets. And we will go through the summarized details of behavioral finance. What is the theory and who is the founder of this theory? We'll go through some examples of this behavioral finance in India, US, and UK, and around the world. We will understand the difference between behavioral finance and standard finance, and what strategies does this behavioral finance has given rise to, and which of these strategies are profitable, which have risen from this behavioral finance, which are different from the standard finance, and whether these behavioral finance strategies are consistently outperforming the market, and what is the ROI of these particular strategies. So that's the topic for today, guys, and let's start. Okay, so behavioral finance and its applicable to trading, and its differentiation between the behavioral finance and the normal standard finance. Okay, so it's, yeah, let's start it. It's taking some time. Yeah, so behavioral finance. So this, what is behavioral finances? So behavioral finance, brings psychology. Actually, psychology is a field. Human psychology, it's a complete field. Okay, and what this behavioral finance is, it basically says that psychology of a human being also impacts trading and the financial markets, and psychology of not only human beings but also crowds and masses has also an impact on, even nations also has an impact on the financial markets. So that is what behavioral finance is. It is an intersection of basically finance and psychology, and how the psychology of human beings, groups of human beings, affects the financial markets. That is this behavioral finance. So behavioral finance explores how cognitive biases, there are a lot of cognitive biases which are there within a human being. Loss aversion is one cognitive bias. So you want to, human beings have a natural tendency to avoid loss, and that is a psychological a cognitive bias is there. They have a bias, to hold on to things which came to them, or which they have some emotional attachment to, like the house they are born in, or the house where they grew with their father or grandfather, and so on. So that's a emotional attachment. Some emotional biases are also there, and loss aversion is there, and herd following is also there. Like if a group of people are following something, or a herd is doing something, then people try to follow the herd. So that is also a herd behavior is also there. And yeah, people generally take some, when there is uncertainty, and when future is not known, then they also seek approval, or they feel like, someone has, if someone is in the boat and whom they trust, basically they also will be in the boat of investing or trading that particular asset class. So the such cognitive biases are there, emotional biases are there, social influences are there, which if some famous person has uh, said that, this is what I'm doing, and this is what I'm doing, like Bitcoin, some people were buying long back ago, then people will try to follow those influential people, and then it becomes a norm. Okay, so that is what behavioral finance is. So behavioral finance explores how cognitive biases, emotions, and social influences impact the financial decisions, and it challenges the assumption that fully rational actors are embedded, which is a fundamental assumption in classical finance, that all the actors are fully rational actors, which is wrong. Actually, no one is fully rational. Okay, because we don't have full information. Okay, And even if there is full information, you can't your brain is not structured to process all the information. So there is always information asymmetry that is there. And along with that information asymmetry, you also have your own psychological biases, or emotional biases and social influences that impact financial decisions. At any point when you're taking a decision, whether it be financial or any decision, you work with limited amount of data and limited amount of time. And with that data and with that within that time, with the biases you have, you'll come up with a decision. Okay. And yeah, so that is what this is what this entire field of behavioral finances. And yeah, it basically challenges the basic assumption of classical finance that all people are fully rational actors. So who are the foundational thinkers of this behavioral finance? Daniel Kahneman and Amos Tversky. These people have founded this, and they developed something called as prospect theory in 1979, which explains asymmetrical risk perception and loss aversion. So what this basic theory says is the pain of losses outweighs equivalent gains. Okay, so what they're saying is human beings have, when you incur a loss, that pain is more, okay, compared to the happiness or delight you get when you get a similar profit. Okay, so loss will give more pain to you compared to the happiness that you gain from profits. So that is what is also called as loss aversion. So because loss will give you more pain, so you will try to, as a human being, try to avoid loss or try to minimize loss. So that is what is called as loss aversion. So that is what is developed by Daniel Kahneman and MS Tversky. Then, on top of them, Richard Thaler has built upon their work and coined terms like mental accounting, endowment effect, and exit as a behavioral economist. He won the Nobel Prize in 2017. Mental accounting is human beings have a tendency to put, do to mental accounting. Okay, so the cost for like house rent, and some things you'll have an account for that. You'll have an account for personal expenses, and that's all a mental accounting you do. It's all in the brain. You'll have boxes for each particular thing. So that is what is the mental accounting. uh, Endowment effect is, I told you, right? If you're born in a certain house, you have an attachment to it. And even though the value of that house is less as per the market rate, it is more for you because you have an emotional attachment to it. So that is what is endowment effect. Okay. Robert Schiller again developed on the work of Daniel Kahneman and Amos Tversky and Richard Thaler, and he demonstrated that excess market volatility, uh, that in the market there is something called as excess market volatility, and it is inconsistent with efficient market hypothesis theory. What is efficient market hypothesis theory? It basically says, you can never beat the market, and market is fully efficient, and no one, even if you do technical analysis, fundamental analysis, whatever you do, macro, micro, industry analysis, or fundamental technical analysis, market is very efficient, and you can never beat the market. That is what efficient market hypothesis says. And random walk theory says, future is completely independent of the past. Okay. But what Robert Schiller found is, that there is excess market volatility, and that market volatility is inconsistent with efficient market hypothesis. And he pioneered behavioral perspectives on bubbles and investor sentiment, bubbles and crashes, and investor sentiment during those things. So these are the foundational thinkers of behavioral finance. Okay. So what is the difference between behavioral finance and standard finance? So, standard finance assumes that everyone is rational, all the players, and everyone is a risk averse agent. Behavioral finance, on the other hand, understands that humans have systemic biases and emotional biases also. Okay. And yeah, sometimes you may not be risk averse. You will see people taking risk which is totally it doesn't make any sense. Okay. And it's not hedged also, so that sort of behavior cannot be explained by standard finance. And people valuing some things more because of their attachment or emotions to it. So that is the difference. Market pricing, always standard finance only reflects on the fundamentals, but behavioral finance can deviate due to herd behavior. So everyone is buying, you also get onto it and buy, and that is herd behavior. And overreaction to like crashes and bubbles. Overreaction would be there, like in Corona, the price went 20% down in Nifty. That is overreaction. Okay. That is it. That happens due to behavioral finance and herd behavior and overreaction. So not always the market is priced based on fundamentals. It is also priced based on herd behavior and overreaction of human beings, and due to the biases, systemic and emotional biases of human beings. Risk evaluation, in standard finance, capital asset pricing model, you have expected utility, have based on that you evaluate the risk. In behavioral finance, there is prospect theory and mental framing is there. That is, loss aversion and mental accounting is there. Strategies, yeah. So what efficient market hypothesis says is, you passive indexing only you need to do, and factor investing only you need to do. There's no need for any fund manager, anything, because they can never beat the market. Okay, that is what that efficient market hypothesis says. And even if they beat, that is just a luck or chance, and it's not. It is one of cases what it says. But behavioral finance says, you can beat the market, and you can beat the market by following a contrarian strategy. And we have seen many hedge fund managers follow this contrarian strategy. The Japanese guy, the bedroom trader who made millions of dollars, followed that contrarian strategy. Even Kenneth Griffin followed that contrarian strategy, and Paul Tudor Jones followed the contrarian strategy. And that is when you will beat the market. Okay, when you follow this contrarian strategy or a momentum strategy is, you ride the trend, you follow the momentum in the trend. And when you follow these strategies, contrarian strategy, momentum strategy, or value investing, Berkshire Hathaway is an example of it. Value investing, it has consistently beaten the passive index funds. Sentiment trades, if you take based on market sentiment, that is when crashes are there over, the market is over in fear, then if you take a buy trade, that will give you good returns. So that's, these are all explained. This contrarian momentum value sentiment trades, so giving more returns than passive indexing, is explained by behavioral finance. And these strategies are behavioral finance strategies, and most of these strategies are followed by all the hedge fund managers, and that's where they made the money. Okay. Goal is benchmark tracking in standard finance, and just to get generate the same returns as the benchmark. But in behavioral finance, it's exploiting inefficiencies and generating more returns or anomalous returns more than the market. That is the goal of behavioral finance. So behavioral finance models explain persistent anomalies, example value and momentum effects that efficient market hypothesis cannot explain. Behavioral biases and investment strategies. So common biases which are there are, overconfidence and disposition effect. So investors trade too much and hold losers too long. So this is what is called overconfidence and disposition effect. Trading too much will never make you profitable. You will incur transaction costs. You know, more number of trades doesn't mean, you will be profitable. Okay. Yeah, and most of the successful traders only take few trades, which and more high probability setups only they'll trade. Okay, and holding losers too long, that is entirely psychology is wrong. Okay, there you will definitely make money. You need to cut the losers quickly. So that is overconfidence and disposition effect bias is there, which is a behavioral bias. And herding and FOMO is fear of missing out. So buying on social proof, like Bitcoin surges, it has led to bubbles. So herd behavior, everyone is buying, I'll also buy. Fear of missing out, I'll miss out this entire rally. Okay, so FOMO. So that also is a common bias, behavioral bias, and investment strategy that generates from that behavioral bias. Okay, anchoring and mental accounting. So investors fixate on arbitrary price levels or treat money differently in different accounts. Okay, So that is also there. So you will treat money differently in different accounts, mental accounts. Okay. So profitable behavioral finance strategies are momentum trading is a profitable behavioral finance strategy, and this momentum trading is generally a swing trading strategy. It happens from some weeks to months, 3 to 12 months returns continuing. So behavioral finance is given to this momentum trading, contrarian, long-term reversal, value investing strategies, and these are profitable strategies. Okay, they beat the market. So momentum trading, 3 to 12 months returns, continuing. This is documented by Jagadish and Titman, and it in Indian and global markets. So it is giving good returns. Contrarian long-term reversal strategies, buying past losers and shorting winners. These losers have outperformed winners by 30% over subsequent 5 years. Yeah. So this contrarian long-term reversal, contrarian strategy, the Japanese trader BYK or bedroom trader, he is famous for even Paul Tudor Jones and even Kenneth Griffin. They bought during the subprime crisis, uh, Kenneth Griffin, and it shot up in value. And many people bought during Corona also. Bill Ackman, I think, bought during Corona, and it gave phenomenal returns. That's a contrarian and long-term reversal strategy. Value investing with behavioral tilt. Yeah, firms like Fuller and Taylor exploit investor overreaction and underreaction. So value investing has outperformed the benchmark by 1% over 25 years. Examples from India, US, UK, and globally are USA Fuller and Taylor Behavioral Value Fund, long only value stock strategy focusing on mispricing driven by psychological biases. This outperformed Russell 2000 value benchmark by 0.91% from 1998 to 2024, even on a risk-adjusted basis. LSV, Lakonishik, Schleffer, and Vishny value stock fund returned 11.2% per annum versus S&P 7.5% since 1993, driving by exploiting value anomalies underpinned by bias literature. India, behavioral driven momentum portfolios. Reddit users backtested 1 year return ranking BSE 500 and found a 3 month holding produced solid gains consistent with momentum behavior. Momentum portfolios have outperformed the normal index. Investor behavior. Studies in India show overconfidence and familiarity bias lead to under diversification and poorer performance among retail investors. So, retail investors are losing because of overconfidence and familiarity bias. Okay, you can globally market imitation and win, stay, lose, shift behaviors or globally dominant. People tend to follow recent winners and change direction after a loss. This is seen independent of fundamentals. That is what happens in the market. Even though the fundamentals of a stock or very good company are good, if it is going down and everyone is shorting it, people generally exit that position. Okay, like what happened in Corona, they exited because portfolio is in red, 20 to 50%, right? So people, independent of fundamentals, people stay with winners, and they try to get away from losers. Staying with win and losing shift. Twitter mood study aggregated US sentiment and predicted Dow Jones index direction with 87.6% daily classification accuracy, performing baseline models. Returns and evidence momentum, a long documented premium of 7 to 10% per year over market returns. Contrarian reversal losers outperform winners that by 30% over 5 year subsequent period in global sample. So this outperformed by 30%. Okay, so losers outperform winners by 30%. That is what is the study and evidence. Behavioral value funds, 1% additional alpha they have generated, uh, and that to risk adjusted. LSV funds 11.2% versus 7.5% of S&P. So why this matters? Behavioral finance. Behavioral biases are persistent across markets, whether it be India, US, UK, because it's human related, right? So it is there everywhere. And strategies that are based on these biases like momentum, value investing, contrarian, these have historically delivered outperformance. And they have delivered out more returns than the index funds. And when they are especially applied systematically and with discipline, they will definitely beat the market. Okay. And understanding psychology helps you, be a better trader and avoid over trading or panic selling. Or capitalizing on, when panic selling is there, capitalizing on that opportunity also, it helps you. So that is the behavioral finance, guys. Behavioral finance explains, why some people are able to beat the market, why markets are not fully efficient, and which strategies are consistently beating the market, like momentum strategy, contrarian reversal strategy, behavior value investing strategies, you know and what is the psychological basis why these strategies are, beating the market, and what cognitive biases, emotional biases, social biases a human has, and how it impacts the financial markets and trading. So that's it for today, guys. Thanks, have a nice day, bye.